Good evening, ladies and gentlemen. Thank you for dialing into this call. And I hope we'll make it really informative, incisive, and productive. I will talk about certain key issues which obviously have dominated the narrative around Yes Bank and which we've discussed over a period of time bilaterally, bring you up to speed on those. And then we'll get into a more detailed financial discussion around our Q1 results. If I was to summarize Q1, I would say that, for the bank, it was a quarter of consolidation. And when I say consolidation, I think there were three key attributes to that. The first and foremost was, of course, the ongoing management transition, which I think is now complete. The second part of it was, given, a CET1 of 8.4, it was a quarter for capital optimization. And, we will obviously talk about that in greater detail during the discussion of the financials. And the third aspect of this whole quarter of consolidation was that the macros were fairly challenged. And if you looked at the financial services sector itself, I think it faced unprecedented headwinds. In a scenario that had a backdrop of that nature, I think for us to be able to return to profitability shows the inherent resilience in Yes Bank. And we will provide further data points on why we think that, the quarters ahead look very, very positive for us. I think it would be only right for me to first, dwell on the asset quality. And while you will see that, the BB and below book has grown from 7.1% to 9.4%, I think it is very critical to note that this increase has fundamentally come on the back of two exposures to large financial services players who were clients of the bank even earlier, but their ratings have subsequently deteriorated and now have become part of the BB and below book or the sub-investment grade book. I would also like to mention that the impact of these exposures was finding expression in our treasury income on the mark-to-market, and I think are materially responsible for our profits being far lower than what we were able to generate for this quarter. Having said that, I think it would be now fair to say that, our asset quality has stabilized. And I would provide a couple of data points for you with respect to that. The first and foremost is that in many discussions that happened around the whole asset quality issue around Yes Bank, focuses also on our real estate exposure. And I thought that, it would be good to be able to give you a sense in terms of what that exposure is looking like from a performance perspective. So our total real estate book, as we have disclosed in our quarterly results, is roughly 24,000 crores. 25% of this book has been captured and isolated as part of either the sub-investment grade book or then as NPAs. Of the balance, 75% of the book, I can tell you that we have minimal, slippages. And if I looked at the overall book, the real estate book, from the point of view of SMA2, that number is just a little over 200 crores. Having said that, if I looked at the broader portfolio, just to be able to give you a sense in terms of the investment grade book, the entire SMA2 on the portfolio, entire corporate portfolio of Yes Bank is only 404 crores. We do, of course, have the retail banking and the SME book apart from that. But as you know, the NPAs there are below 1% and in many ways define the industry benchmark in terms of credit quality. So the book, I hope, on the basis of the specific data points that I provided, will give you enough comfort that, on credit quality, things have stabilized and our revenues, our operating performance for the ensuing quarters should be a lot stronger. Let me then talk about capital. I have said this previously and I would just reiterate one message, which is to say that the capital that we need is purely growth capital. This is not for balance sheet purposes. And in support of that assertion, what I would say is that if you look at our PPOP, and I would go to the extent of saying even if you looked at our PPOP in a quarter of consolidation, in a quarter where we didn't have all the growth capital that we needed, all that we would need is 8 quarters of this PPOP for us to be able to provide for any slippages that may occur in our sub-investment grade book. So I think it is important again to note that the capital that we are looking to raise is purely growth capital and is not capital that is being sought to improve our absorption buffers for provisioning. Given the franchise performance for the quarter, I think it gave us a lot of confidence. And more importantly, it has given a lot of confidence to the investors who have been engaged with us. We have had very strong institutional investor engagement and interest, both on the private side and on the public side. And investors have now come to recognize that our legacy issues are not granular, but restricted essentially to a handful of names. And each of those resolutions gives material upside. So on that point, I would just reiterate something that we have spoken before, that we expect capital raising to be a Q2 event. Let me then move to some information with respect to liabilities. I think overall, if we looked at our liabilities, we degrew by about 0.8%. And this, in a market which has been sluggish, what we saw effectively speaking was that a lot of our SA went into FDs, and our TDs have grown significantly during the quarter. But even as we capital optimized and in some ways rationalized credit on the corporate side, a lot of the corporate CAR, or a lot of our CAR which came from the corporate sector, some of that we saw move away. But overall, I think the very fact that our TDs grew is indicative of the fact that depositors continue to have trust and long-term commitment as far as the bank is concerned. The last point that I would really like to talk about before we move to financials is really around digital and innovation, which is something which I've often talked about to you collectively and individually. I think the digital leadership of Yes Bank, which we talked about in the last quarter, got further reinforced during this quarter. And I will talk about a handful of data points and statistics to be able to give you a sense in terms of how that is manifesting itself. I had mentioned to you that in all of the previous financial year, the bank had 1.43 billion UPI transactions. Just in the first quarter of this year, we have seen 768 million UPI transactions. And both in terms of value and volume, we are number one in all 3 of these months of the first quarter. And even if we look at the Aadhaar-enabled payments, we continue to command or have grown our market share to 40%. And what is very important to mention here is not just the point in terms of how this feeds into the data intelligence and the data analytics, but all these businesses are profitable on a standalone basis. Equally, I think the bank has been on the front foot. If you look at the Greenwich survey for the year, you will see that we have gone up many rungs across various categories, either in terms of quality of service, quality of products, market share. And it is something which will reinforce the view that we are not de-emphasizing the corporate bank, far from it. And the fact that based on the quality of service, the quality of product offering, and the quality of people that we have, our corporate clients continue to repose very strong faith and trust in us. We have also stayed on the front foot, even though I did mention that this was a quarter of consolidation, and we're now there winning business. And some of those wins, I would like to talk about. The first and foremost is one of the most fiercely competed mandates for API banking was pertained to the single largest telecom company in the country. And I'm delighted to mention that Yes Bank won that mandate. Similarly, if you looked at the whole BSE Star mutual fund cash management mandate, where they collect funds for mutual fund investment, Yes Bank won that mandate. In terms of the government banking piece, based on our digital capabilities, we won fresh mandates from Maharashtra and the Telangana state governments. And if you looked at the rankings that were put out there by Ministry of Electronics and Information Technology, among 56 public, private, and foreign banks for digital payments performance in the financial year 2019, Yes Bank came up on top. I have mentioned this to you earlier as well, that, and I'm sure that's a belief that many of you share, that technology is going to play a bigger, stronger role in financial services. The displacement it will cause, the disruption it will cause will be significant. And I would like to believe that Yes Bank is better positioned to benefit from that and to be able to monetize and harness that opportunity ahead of competition. So overall, what I would say is that we feel very assured that the hard yards that we've put in this quarter have firmly put the house in order, if I may use that expression. And we can now start to look for very strong growth in the coming quarters. And if I could then finally say one more point, we had talked about, the strengthening our senior management talent. So at the introduction of the call, you heard of Anurag Adlakha here, who heads financial management strategy for us, has had a very, very sterling career in banking, and many of you would know him. And equally, as head of compliance, governance, and controls, we've had Rajiv Uberoy join us. Rajiv, again, comes from a very, very strong and successful career in banking across Reserve Bank of India, around foreign banking, and then the Indian private sector banking space. So we will continue to augment our management resources. We will continue to invest in people in terms of key businesses. Given the overall dislocation in the NBFC space and in financial markets, I think the opportunity to grow is very significant. And I would say that, Yes Bank is uniquely positioned to be able to get a disproportionate share of the pie that is now becoming available. And I would like to thank you, each one of you, for your support, and look forward to your continued guidance and backing as we get onto even stronger footing. I will now hand over to Rajat to go through the financials, and then we are happy to take questions thereafter.
So thank you, Ramneet. I'll take this next few minutes to update on the specific financial performance of the bank in the first quarter for fiscal year 19-20. As Ramneet had mentioned, this has been a return to profitability sort of a quarter. And in this quarter, our net interest income has been reported at 2,281 crores. This, of course, has been somewhat impaired by the impact of about 223 crores on account of interest reversals resulting from slippages that took place during the quarter. The fee performance, on the other hand, improved on a sequential basis, and our pre-provisioning operating profit therefore grew 48% sequentially to 1,959 crores. We are reporting a net profit after tax of 114 crores for the quarter, and this is after absorbing 1,109 crores of impact on account of mark-to-market provisioning relating to investments in bonds of the financial services companies that were referred to earlier in the commentary. The loan book of the bank stands at 2,36,300 crores as at the end of the quarter, and it has grown at 10.1% on a year-on-year basis. Internally, the retail advances book has grown at 43.3% on a year-on-year basis and at 7.2% sequentially, and it now contributes 18.3% of the bank's loan book, and this position was at 14% of the bank's loan book at the same time last year. As such, the retail loan book also contributed to 60% share of the incremental loan book of the bank during the last 12 months. So I think the situation on the retail banking side continues to be in good momentum, and it is acquiring incremental sequential share of the bank's loan book every passing quarter. Some more statistics on the asset quality position of the bank. The credit cost incurred in the quarter gone by was 32 basis points. The bank is maintaining its credit cost guidance of up to 125 basis points for the fiscal year 19-20. The provisioning coverage ratio of the bank is also maintained at 43.1%. Some statistics on the liability and funding side of the bank. The deposit book on a year-on-year basis grew at 5.9%, and now stacking up to almost 2,26,000 crores. Internal to the deposit book, there has been very good growth in the retail time deposits category. The retail time deposit book has grown at about 38% on a year-on-year basis and at 8.2% on a sequential basis. And it, as such, is now accounting for 28% of total deposits of the bank. The CASA ratio of the bank is being reported at 30.2%. This has seen a sequential reduction on account of somewhat weaker quarter-end flows in the quarter gone by. So while the deposit growth has been modest, however, within the internals of the deposits, we are seeing the retail banking business take incremental share. So while the headline is a modest 6% growth, the intersect growth between retail is far higher, and therefore the non-retail deposit funding share is continuously reducing. The LCR position of the bank as of June 30th stood at 132.6%. And for the quarter as average, it stood at 117.3% as compared to 111% in the sequential previous quarter. So the liquidity position of the bank has also been improving, and it is reflecting in somewhat in also higher LCR as well as some moderation on account of this into margins as well. The capital position of the bank stands at 15.7%. Within the total capital adequacy ratio, the Tier 1 ratio stands at 10.7%, and the CET1 ratio stands at 8.0%. The bank has taken some charge on account of capital in this current quarter, resulting from regulatory changes on account of unrated exposures. Beginning this quarter, if any bank is holding unrated exposures, they are required to be risk-weighted at 150%, irrespective of the underlying quality of the borrower. So typically, MNCs, some government entities do not readily provide ratings, and therefore there is somewhat of a penal risk weight that is also to be applied there. The bank took a 20 basis point reduction in its Tier 1 CET1 capital on account of this regulation. The bank also took a 16 basis point correction in its CET1 capital on account of the credit rating downgrades in its investment book, particularly relating to financial services companies. And as I mentioned, that stood at 16 basis points charge. Every year, the capital required for operational risk also increases as it is linked to the last 3 years of turnover of the bank's business. And as the years roll forward, there is an automatic increase in capital charge for operational risk, and a 10 basis point of CET1 was consumed on account of this roll forward. These three developments resulted in the bank's CET1 reducing by 36 basis points, which is what has been the driver behind the reduction in CET1 headline from 8.4% to 8.0%. Sorry, I stand corrected. It is 46 basis points. Ramneet already highlighted the bank's leadership position in digital payments. I would like to add just a couple of facts there. The bank has very recently facilitated a first-of-its-kind issuance of commercial paper using blockchain technology. This will be the first of its kind in Asia, where commercial paper issuance has been onboarded on the blockchain platform, which ensures the sanctity of the multiple participants that have to come together to facilitate a transaction. The bank's API banking platform continues to be a preferred program for clients, and we have crossed more than 1,000 customers that are using the bank's API banking platform, and the bank has emerged much of a lead and a bank of choice across many unicorns in straddling their services with banking using the API platforms. On the digital banking performance, as measured by the Ministry of Information Technology, METI as it is referred for short, ranked the bank as number one among 56 private and foreign and public banks for the fiscal year 19, the digital performance league tables. So as such, the bank continues to occupy leading or near leading positions in digital payments, which would be UPI or Aadhaar-enabled payments or IMPS, among others. Few more statistics on the balance sheet and the mix of the balance sheet. So the total assets of the bank grew at 11.6%. They now total to 3.7 lakh crores. Within the loan book of the bank, the share of corporate banking has sequentially reduced from 65.6% as at March 2019 to 63.9%. And as I was mentioning earlier in my commentary, the share of retail banking has correspondingly increased from 16.7% to 18.3%. On a year-on-year basis, the change is a little bit sharper. So the corporate banking mix has reduced from 67.6% as at June 30th, 2018 to 63.9%. So there has been about a 3.5% reduction in that mix, and correspondingly a 4.3% increase in the retail banking mix has also been observed. And the another statistic on the balance sheet side would be the total risk-weighted assets of the bank, and they stood at 3.23 lakh crores as at June 30th, 2019. Some more data points on the asset quality position reported during this quarter. While the gross NPA headline has increased to 5.01% and the net NPA headline has increased to 2.9%, the bank has maintained its provisioning coverage ratio. During this quarter, the bank has sold one NPA account, which would account for an exposure of 4.11 billion rupees or 411 crores. This is sold to an ARC. During the quarter, the bank experienced slippages of 6,232 crores. However, there were some technical downgrades and upgrades, which accounted for 1,678 crores. The net slippages during the quarter would stacked up to 4,554 crores. The slippages from the corporate book were entirely from the accounts which have been previously disclosed as BB and below. And on the asset quality front, the credit cost guidance is reiterated up to 125 basis points for this current year, and 32 basis points have been utilized in this current quarter. Our press release and investor presentation also have the disclosure on sensitive sectors, so you can go through at your luxury. There has not been much change as such between the last disclosed to this particular disclosure, and more or less stable. And lastly, some statistics on the bank's employees and branches, as well as some mention on the recognition that the bank received in the last quarter. So the bank's employee strength as at June 30th, 2019 stood at 21,745 employees. The bank is operating 1,122 branches and 1,220 ATMs and note accepting machines. The bank was recognized fifth year in a row by Asian Banker as being the best trade finance bank in India. In the same awards, the bank was also recognized as having executed the best corporate trade finance deal in India, the best financial supply chain management deal in India. The bank also saw its transactions get recognized at the AAA Asia Infrastructure Awards, where it received the best deal in India award for transportation sector, for the utility sector, as well as the renewable energy sector. The renewable energy deal was also highly commended. The Global Finance magazine also highlighted the bank as being among the 25 best financial innovation labs in the fintech space, as well as it being among the innovators in trade finance. The bank also maintained its leadership position in the debt capital market space. In the quarter gone by, it was ranked among the top 3 arrangers in the first quarter in the private sector manufacturing category by Prime. The bank executed transactions across sectors, which will include renewable energy, both solar and wind, engineering, transmission, and InvITs. The bank has also started to gain traction in the offshore debt capital market business, and in this quarter gone by, it also acted as a joint lead manager to 3 high-yield offshore USD-denominated bond issuances, which were largely done in the airports and the renewable energy space. And the bank also was ranked as the number 3 MLA in the local currency syndication for the first half of the calendar year for sell-down and refinancing of loans. So this was the summary of both the financial highlights that we wanted to communicate upfront, as well as some operational and recognition outcomes that the bank saw in the quarter gone by. We will be happy to take questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mahrukh Adajania from IDFC Securities. Please go ahead.
Yeah, hi. So I have a couple of questions. Firstly, on the GSEC, so there's a transfer between categories, and also there's been a sale of HTM. So what are the GSEC gains, and if at all there's a write-back in provisions on GSECs as well?
So the gains on account of GSECs, in general, if I can say treasury gains, Mahrukh, was 4.5 billion rupees, so 450 crores.
Okay, and was there any write-back of provisions on GSECs or on any other corporate bonds? I mean, there was, of course, a write-off, MTM on NBFCs, but was there a write-back also?
There might be some minor write-ins or write-backs, but nothing of consequence.
Okay, and my second question was on the stress book. So, of the watch list of 100 billion that was talked about last quarter, how much of that would have slipped?
So about, let's say the net slippage, if I may address, which is about 4,500 crores, about 2,500 crores is from the book, identified book. And the balance is from the BB and below book. And I'm excluding retail and SME for this math.
Right. So the BB and below book is the 9.4%, right? That one of the corporate book. Got it. And just one more question again on stress loans, that there has been, there is likely to be a regulatory change in AP, which is one of the biggest or the fastest growing markets for renewable energy. Right? Because investments after FY17 in AP on the renewable front really rose sharply. So what would be your renewable exposure to AP and in general the quantum of your renewable exposure, and do you see any risk?
So AP is not a risk in our portfolio. I mean, it will be a small minority proportion, maybe a single-digit percentage of our exposure to AP as such from our renewable energy portfolio.
Okay, but what would be the size of the renewable energy portfolio?
Renewable energy portfolio as a percentage of a loan book would be, I will repeat the number later when I get the exact number. It will be about 4% odd of the loan book.
Okay.
A lot of the renewable energy is routed, you should understand, via the intermediate. So AP, for example, in this instance is also not, it's negotiating with the intermediate entities, which are the off-takers from the power producers.
Correct.
So there is a should I say, a buffer in the middle as such, and this is, I'm sure there is a little bit of politics in play here, so contracts will be upheld finally.
Got it. Okay. Thank you.
Thank you. The next question is from the line of Amit Premchandani from UTI Mutual Fund. Please go ahead.
Thanks for the opportunity. This 1,600 plus crore upgrades, all are from the technical slippages, or there are some genuine upgrades also?
They're all technical slippages, all of them, the entire 1,600 crores.
And of the 25 billion which slipped from BB, the rest, how much slipped from BB and below? Sorry, 25 billion from the 10,000 crore. And the rest, how much slipped from BB and below?
About 2,100 crores.
If you exclude the retail and SME slippages, all of it.
And what is the retail and SME slippage?
Little over 100 crores.
Okay. And the revised watch list is this 10,000 crore and reduced by 2,500, or it is 29,000 crore of roughly the BB and below?
No, the watch list remains at 10,000 crores. Even though just 2,500 crores has slipped out of that, we continue to watch the 7,500 crore very closely. But in terms of the overall composition and the size of that watch list, nothing changes at all.
And what is the meaning of this watch list if 2,100 crores slips from outside this watch list?
So I think when we put out the watch list, we were very close to, or rather we were just initiating the whole process with respect to equity raise, and we thought that, we should proactively be able to tell investors of where the potential slippages could occur. These were accounts in which there were repayments coming up and where we didn't think that the cash flows really would be in a position to support for them to be able to meet those liabilities. Eventually, the slippages didn't occur, so I thought maybe we were a little bit more conservative. But the balance that you talk about, I think I would tend to look at them more as, slippages in the normal course of business, even though they came out of the watch list, but very much from the BB and below book.
And so how do you rate the overall risk management function in the bank when BB and below book has moved from 2.5 to 9.5 in 2 quarters?
So I think what needs to be really clearly understood is, and we had mentioned this in the last quarter as well, that the increase in the sub-investment grade book came essentially on the back of 3 very large exposures. And even if that book has increased in this quarter, it comes on the back of 2 of the investments that we had, again, to these very entities, which, as I mentioned earlier during the call, during the last quarter was still investment grade. So I would, again, like to emphasize this point that this is not a large granular book, which is the sub-investment grade. It is concentrated, it's a handful of names. And so, to use these as a reflection on the overall risk management function of the bank to my mind, would be inaccurate. If it was a very large granular book, I would have definitely seen substance in the point that you just made.
And sir, how much of this 9.5% BB and below was originated or sanctioned in July to September 2018?
That will not be a significant amount, Amit. I mean, we'll not be able to say that it was zero because we'll have to go back and double check that, but I don't think it will be a significant amount in terms of sanction.
And finally, this 125 bips, does it include the NBFC mark-to-market hit which you have to take from the bond portfolio, right?
No, it does not, because it's not, we can not been classifying the MTM provisions in credit cost because they could also be simply on account of interest rate movements, and it is not, I mean, we can discuss and argue that, but it is not easy to delineate how much of that is credit cost and how much of that is relating to interest rate yield movements.
And how much hit have you taken to that MTM, the bond portfolio of these two NBFCs?
So in this quarter, 1,100 crores.
In terms of percentage, it is 50% or 25% or?
It will be between 20 and 30%.
Okay. Thank you. That's it from my side.
Thanks, Amit.
Thank you. The next question is from the line of Samir Pise from JM Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just wanted to ask, within the BB and below pool, are there any loan exposures which are also there in the bond portfolio which just got downgraded in the quarter? Or is it just bond exposures and loan exposures are not there?
No, so I'm just thinking aloud. Theoretically, if there was a loan exposure, it will also be there in the BB and below category. But in terms of just my quick recollection, there would not be, there might be a small loan exposure. It's mostly bonds.
Okay, and so effectively none of these two entities were in either BB and below or any of the watchlist discussions that were there last quarter. Is that a fair assessment?
That's correct, because their credit ratings which were available at that time were,
right.
In one case, at investment grade, and the other case, far above investment grade. Yes.
Yeah, fair enough. And any specific sectoral bias to the slippages this quarter?
No, we don't see any particular sector which dominates the slippages in this quarter. No, not really. And just to come back to the point that the previous question that you asked with respect to the bond portfolios, while one of the entities was not captured because, like we said, it was investment grade during the last quarter, the second is part of a group which is very much present in our sub-investment grade book, where the entire funded, non-funded exposures were, captured. But since the bond portfolios were at that time investment grade, that was not included.
Okay. But is there any entity which has slipped from the group otherwise, which is obviously not the financial services entity?
So one entity which was part of the watch list from that group has slipped.
Okay, and I think that would be a reasonable proportion of the 6,200 crores of gross slippages.
So yeah, if you don't mind, let's not speculate in terms of single account, because it will not be right.
Okay, fair. Thanks a lot. All the best.
Thank you. The next question is from the line of Saurabh Das from Franklin Templeton. Please go ahead. Saurabh Das from Franklin, your line is unmuted for questions. Please go ahead.
Yeah, hi. This is Saurabh. Am I audible now?
Yes, you are.
Yes.
Thanks, and hello, everyone. This is to Ravneet. My question is on capital raising. So if you can share with us any visibility on timelines, first. Second, that in the event of a delay, are you looking for aggressive sell downs? And isn't it already, high time that we aggressively do that? I was hoping to see some of that in this quarter itself. And lastly, do you envisage any regulatory actions since we are already at 8? Any further drop from the CET1 levels will possibly trigger prompt and corrective action?
So, if you look at the fact that, churning of the balance sheet, I mean, when I talked about capital optimization, that was a very big element of, churning was a very big element of that. In the last quarter, what we had said was that, we will look to granularize the balance sheet, and true to that, we were able to churn our corporate portfolio and grow the more granular retail portfolio. I think if you see not just for the previous quarter, but even on a more long-term basis, the bank has demonstrated the ability to be able to churn its portfolio, to be able to optimize capital. And I think it was no different from in the previous quarter. And we continue to do that regardless of, any concern that we may have with respect to the timing of the capital raise. So that is something which is a very high priority. And when I talk about capital optimization, that's what I essentially did, allude to. As far as, the capital raise is concerned, the interest from investors has just grown over a period of time, both public and private, which has opened up multiple options for us. And as I mentioned earlier in the call, that we continue to see it as very firmly as a quarter two event.
Regarding any regulatory actions you see?
No, so we don't, look, I think we maintain a very close dialogue with the regulator, and, very openly and constructively share all the developments with respect to the bank's operations, balance sheet, etc. And I don't see any of that being on the anvil at all.
But, will the dialogues help if we drop below CET1? I mean, does the regulator have that leeway to?
No, obviously not. But the point I'm making is that, in terms of the bank's performance, that is very transparently communicated to the regulator. So there is nothing that should surprise the regulator. And we don't see, frankly, a situation arising wherein we will drop below the regulatory threshold.
Okay.
We think we have multiple levers. Again, I will just put this on record. We think we have multiple levers to ensure that, we don't get into that territory at all.
Yeah, because, Ravneet, while on one side we are trying to keep the loan book static, we are trying to, optimize within that to bring granularity. Certain events like NPAs are beyond our control. And just in one quarter, a few NPAs resulted in 20-30 basis points of capital consumption, which we can't, any further afford if we are already at 8. So that's where, the sense of urgency and the question.
Yeah, I mean, I completely agree with that, and the sense of urgency is not lost on us. I think 2 points I will just make over here. That I think there was a concern that the market did express some time back in terms of whether we would be able to, meet our credit cost guidance. If you see the complexion of our portfolio, specifically the portfolio, which was sub-investment grade, which was part of the watch list, do bear in mind all of that was front-loaded. And despite all of that being front-loaded and there being no recoveries from any of those names in this quarter, we only did consume 32 basis points of credit cost. So we feel completely confident in terms of being able to meet a credit cost guidance of 125 basis points. But more importantly, the point that you made, that slippages are, could erode capital and then take us into, dangerous territory, is fully understood, and we are very cognizant of that.
Okay. Thanks and all the best.
Thank you. The next question is from the line of Henrik Milton from Coeli Asset Management. Please go ahead.
Yes, hello, this is Henrik here. I have 3 questions. The first one is regarding Rana Kapoor, and I'm just wondering to what extent is he still a part of the bank, except for being an owner?
So the clear answer to that is that other than the fact that, he is the largest shareholder of the bank, he has no involvement, executive or non-executive, direct or indirect.
Okay, and he will not be a part of the bank for the next couple of quarters. I think that for now, he's still out of the picture, so to say, or?
Yeah, that's correct, unless something else changes, but that's the base case.
Okay, now the big picture of the non-performing loans, I just wanted to be clear regarding the NPL trend, if it's improving going further or if you see something else coming on the next quarter.
So as I mentioned, that we think that our sub-investment grade book has now completely bottomed out. I gave you a sense in terms of what the real estate portfolio is looking like, given the fact that, that is a question that often comes up from investors and analysts. And I also gave a sense in terms of what our overall corporate book looks like. So I would say that when I look at the near to medium term, I think it looks very promising. And I don't see any material slippages outside of what has been already indicated and clearly put out there in the market.
Okay. And then you have some promising achievements on your retail side. I'm just wondering, when you grow on retail, is it better pricing versus competitor, or is it better services? What is it that makes you taking market share on the retail side?
I think there are a couple of very clear factors. It's definitely not pricing. We will not compete on pricing. I think the performance of retail, and which has been very impressive, comes on the back of a couple of things. First and foremost, I think they have been very solution-driven, and they have come up with very specific solutions for certain industries, which has given them a market leadership position over there. Second, I think if you look at it from the point of view of use of technology and use of customer usage, I think they are setting the benchmark, across the board. And the third is that, the whole usage of data analytics in terms of pitching the right product to the right client, pricing it correctly, setting the right limit, is something which is now beginning to pay off in a big way. Also, I think what the business did was that out of 1,100 branches, the strategy is now absolutely aligned branch by branch based in terms of what is the business potential of the catchment area of that particular branch, what kind of products we should be offering there, and what kind of people should be manning those branches. So I think a combination of a very solutioning-based approach, great data analytics, and third, products which are suited to specific industries are the real factors behind the very impressive growth of retail. I can promise you it's not being driven on the back of pricing.
Okay. Well, thank you very much for a very interesting report. Thank you.
Thank you.
Thank you. The next question is from the line of Nilanjan Karpa from Jefferies. Please go ahead.
Hi, Avneet. A couple of questions. At least when I look at the corporate rating profile and the total below investment grade book is about 29,000 crores, out of which quarter is investments. I believe in our annual report we had this number close to only about 500 odd crores. So there has been a very substantial jump in the investment grade book, whereas you report only 2 investments where we had to take an MTM downgrade. Is my assessment right?
Sorry, Nilanjan, I not understood.
So, if you look at this 294.7 billion of BB and below, right, that's what the number is, right?
Go ahead, yes.
So 25% of that is investments.
Correct.
Right. And the annual report of March 19, if you look at that disclosure of...
Subsequent to March 19 downgrades.
Correct. And that's a pretty large number. It goes from like 5.5 billion to close to, to about 75.
That's correct. That again, those are concentrated across 2 financial services groups.
Oh, so that's entirely okay.
Just 2 names, as I mentioned earlier, that this entire migration to the sub-investment grade book has come from just 2 financial services names.
Right. And
just to add, there will be about approximately 15 billion rupees, so 1,500 crore provisioning also on those exposures. Maybe a little bit more than that. I don't have the exact number.
Rajat, I kind of lost you there. Sorry, what is 1,500 crores?
Provisioning. So this is the gross exposure. It has also been provisioned, is what I was just highlighting to you.
Right. Okay. And did you also mention, Rajat, that corresponding to these bonds, the loans are probably not there at all. Is that what you said to an earlier question?
That's correct.
Right. Okay. And you also said that these downgrades in the bonds are not part of that 10,000 odd crores that we had mentioned last quarter.
The BB and below book of last quarter, that's correct, because at that time, all these bonds were investment grade or better.
No, not the BB and below, but in the 10,000 crores that you had mentioned.
They were not even there in the BB and below. 10,000 was a subset of BB and below.
Yeah, so 10,000 crores was actually culled out of the BB and below book. These were not two independent numbers.
Right.
The 10,000 odd crores was drawn from the BB and below book of 23,000 crores.
Sure, well understood. And Ramit, in your opening remarks, I might have misunderstood, but did you say you need 8 quarters of PPOP of the similar kind of a PPOP that we delivered in Q1, which will be sufficient for provision of that entire book? Did you say something like that? Because that's a pretty large number.
So what I was saying was that it was said specifically in context to the capital raise. So the question that very often comes up is that do you need capital to be able to absorb more provisioning, or is it actually growth capital? And I was just highlighting the fact that our PPOP is enough to be able to provide the provisioning on our BB and below book, and for that we don't need incremental capital. The incremental capital that we're looking for is really more from the point of view of fueling growth.
Okay. Sorry, and just one probably last question. The SMA2 that was disclosed was 404 crore, and that's entirely corporate. But is it a like-to-like comparison of about 2,400 crore that we disclosed in the previous quarter? Or that 2,400 included everything put together?
2,400 crores was the full bank at that point in time.
Do we have a comparable number of the 404, please? Or either way, or comparable of 404?
So that number is not readily available, but the 2,400 was a full pool bank-wide when we had to disclose that number.
Okay. All right. Yep. Thank you. Thank you so much. If I have more questions, I'll come back. Thank you.
Thank you.
Thank you. The next question is from the line of Adarsh Parasrampuria from Nomura. Please go ahead.
Yeah, hi, thanks. I had a question. Can you lend a little bit more credibility to the, watch list that you've discussed? The reason why I say that is, even in April during May during our first quarter results, with a decent amount of certainty, we could have said some of these investment, markdowns and, recognition that you've done in BB and below could have at least been considered into the watch list, right? Because watch list generally denotes what's probably with reasonable certainty a decent problem set, which will require provisioning and NPA recognition, right? So the first question is just because it was not BB and below, but decent certainty, there's stress around. Why would the watch list not have it? And two is now the difference between the BB book, BB and below, and where the watch list sits. What's your comfort qualitatively, quantitatively, whatever you can kind of add some credibility to that, please.
So, as you mentioned previously, the watch list was actually derived from the sub-investment grade book. So it's not as if that these were two separate pools of assets that we were looking at. Now, if you see historically for the bank, what we do provide is a sub-investment grade book only. We don't provide a watch list. As I mentioned to you, in a spirit of transparency and being more proactive, within the sub-investment grade book, we identified a pool of assets where, like I mentioned earlier, there were repayments coming up and where we thought that the cash flows may not be sufficient for the companies to be able to meet those obligations. And there could have been potential defaults. And at that time, we had said that even though we took a contingency provisioning of 2,100 crore on that watch list, when we declared our results at that point in time, that entire watch list was actually current. I mean, there were no slippages in that watch list. But those were potential slippages that we had anticipated, and in the spirit of transparency had gone out there and, flagged them to the market. The slippages that have occurred outside of that watch list have occurred from the BB and below book itself. They haven't come from other parts of the portfolio. So whatever slippages have happened may not have been entirely captured in the watchlist, but have come entirely from the BB and below book, of which the watchlist was only a subset.
So, given that your slippages are coming from, if I take the full number coming from a larger pool, what comfort should one draw? And it is not like just a quarter or two, but say an 18, 24 month through the cycle kind of recognition that the bank would do. Between that 30,000 crore number of BB and below and the 10 or whatever 15,000 crores of watch list, including some of these, downgraded investments. What is the comfort on that 15, right? When you try and cull out that book, what's the comfort that you have there, not just for like a couple of quarters, but if I take an 18-month horizon?
So, again, like I mentioned to you, that the watch list of 10,000 crores doesn't change. That watch list was put out there for a very specific purpose. And like I said, that even though only 25% of that watch list slipped, we continue to monitor the balance 75% very closely. As regards the sub-investment grade book is concerned, what I told you was that one of the parts of the portfolio which often comes up for discussion is really the real estate book. And in the real estate book, I provided very specific data points to be able to provide comfort that that book is not stressed the way sometimes real estate is currently perceived. So I gave you a sense in terms of the fact that 25% of it was provisioned or already in the BB and below book. And for the balance 75%, there are hardly any, overdue or SMA2. Similarly, if I look at the overall corporate book, I gave you the sense that, we would have roughly about 404 crores of SMA2. I think that should give you a fairly good sense in terms of the ensuing quarters being relatively stable from a provisioning perspective.
Okay, thanks. And the second question is, can you just talk a little bit about, more like normalized fees and margins, especially corporate fees and margins, where you see what you've reported vis-a-vis how things can pan out basis. You've had a bit of fall in CASA, but obviously now your liability side can consolidate. So some sense on visibility around margins and corporate fees.
So as far as the fee part of it is concerned, one of the things that we had changed from an accounting standpoint at the last quarter was that we would going forward amortize the fee over the life of the loan rather than recognizing it upfront as was the practice previously. Having said that, that is not the only reason for the decline in fee. I think the main reason is that we were in capital optimization mode, and in that environment, it would have been unwise, imprudent to be able to go out there and do some very large underwriting, which would have generated the fees. So we decided to take a pause on that, and like I said, more churn the portfolio to be able to invest and create capacity for some of the other businesses that we want to grow more aggressively going forward. I would say that for post our capital raise, you will see a lot more intensity with respect to fee. Obviously, the fee has four elements to it, which is one is the corporate finance, second is retail, third is transaction bank, and the fourth, of course, is financial markets. If I look at it from the point of view of this year, the fee on retail was up almost 23%. If I look at it on the transaction bank, it was up almost 6%. But given the fact that we did not do any of the large underwritings on the corporate finance side, that number came off. I don't think it really is representative of us discontinuing a business or de-emphasizing a business. It really is a timing issue. We think that the market opportunity for that business today is stronger than ever, given what has happened to the broader financial services industry, the tightening of the credit market. I think today there's much better opportunity for that. But like I said, that really is a function of capital, and post capital, you will see a lot of aggressive growth over there. I think as far as the second question was around NI.
Yeah. On margins, yeah.
On margins. So again, one of the things which we of course saw really was, or rather what I articulated in the last quarter was that from being very or almost single-mindedly asset-led, we would become a lot more liability-led. A lot of our retail strategy, a lot of our transaction banking strategy is in terms of, growing a liability business. On the back of digital, I think we've been able to make significant headway there in terms of the entire government banking business, which is obviously the highest liability contributor as far as the country is concerned. And even in this quarter, where I think we had headwinds in terms of news flow, in terms of the operating environment, I think the retail part of it grew quite significantly. I think where our cost of funding got a little impacted was, like I mentioned, that some of the corporates who maintain CAR with us, we saw a little bit of depletion in that on the back of rationalization of credit, which was part of our entire capital optimization strategy. I think once we go back to being at full throttle in terms of corporate credit, I think that piece will come back, bring down our overall cost of funding, which of course, retail is working on as well. And I see that normalizing and actually increasing fairly soundly in coming quarters.
Thank you.
Thank you.
The next question is from the line of Anand Latha from HDFC Mutual Fund. Please go ahead.
Sir, on your... hello?
Hello, yes.
Yeah. On the BB and below exposure, if you can give some color, like in terms of sectoral, which sectors they come from, that will be helpful.
So I think it's again, like I mentioned to you, that if you really were to look at that sub-investment grade book, it actually comprises of essentially a handful of names. It's not a very big granular book which is suffering from stress coming out of a cycle, which could be an industry cycle or whatever else it is. This is not a concentrated sectoral exposure. This is just a handful of names which are, one of which is diversified, others could be in businesses which are, entertainment, financial services, etc. So no, there is no sectoral color to the sub-investment grade book.
Okay. And if I believe within the sub-investment grade book, in a lot of exposures, there are a lot of M&A deal or resolution are likely to happen. If you can give color, suppose a deal happens in the media industry, what sort of book reduction can happen, or a deal happens in a diversified government, what sort of book reduction can happen?
So I think we are very well collateralized in these exposures, and if a resolution was to happen, and you mentioned two of those names, I think a resolution is very imminent in the third large exposure also, and I think if these resolutions were to come, I think I just mentioned at the beginning of the call that investors are now beginning to realize that it's just a handful of names, and if there is even a single resolution, the upside is material. I would flip that even from a credit standpoint, that if resolution were to happen in these names, and we definitely expect some of these resolutions to happen in this quarter, it would lead to a material reduction in our sub-investment grade book. Material reduction.
But at this point of time, you don't want to quantify what number that can be.
The only reason I don't want to quantify it is that these resolutions are underway. We'd like to see them play themselves out. Some of these have got reported in the media, which I can, tell you are exaggerated. I think these resolutions are going to be a lot friendlier to lenders, to investors. So I won't want to hazard a guess, but what I can definitely say with great certainty is that it will lead to a material reduction in our book.
Okay. Further, since the bank has been doing a lot of structured finance, also holding company level sort of lending, if you can say what could be the rating of those lending? Is it a part of single A or a part of triple A book?
So first and foremost, our lending, you said one was holding company. What was the other part that you talked about?
I said structured lending or a promoter level funding or a holding company level lending. If I had to look at the rating of those lending, it will be part of what? Triple B book or a single A book? Single A rated book?
So actually, if I look at a majority of our holding company financing, it is part of our double B and below book. I don't think there is anything of any substance outside of that.
Okay. So like typically a bank does a stress test. So you could have done some stress test on your triple B book. So is there any probability that some part of that can fall into double B book or below in over next 2 to 3 quarters or next 12 months?
To say that a double B
BB book will be
So,
yet lower?
yeah, I mean, given the fact that some resolutions now look imminent, I would think that going forward, actually our sub-investment grade book should fall considerably.
No, my question was on the BBB book. So, is there any probability if you do a stress test, some part of that BBB book can fall into BB over next 2-3 quarters? Or
No,
how comfortable you are in that?
Reasonably comfortable that won't happen.
Perfect. And lastly, on the margin side, if you can give some color, like what sort of margin do we expect, and what are our lending rates on the corporate? So, what are our yield on advances on the corporate side, and what is the yield on advances on the retail side?
So, the yield roughly stacks up to, I would say, maybe corporate yield would be 9.75 to 10 range in terms of averages. The retail yield would be between 10.25 and 10.75. SME yield also will be in the 10.5 handle. Okay. The averages. Of course, the range of corporate yields will be a lot higher. Let's say the AAA yields will be closer to, let's say, 7-8%, and some of the structured deals or, let's say, real estate transactions might also be 12-13%. So the spread is higher. The spread in SME and retail will be narrower, but the averages would be, like I was saying, about little less than 10 for corporate, little more than 10 for SME, and about 10.5 for retail.
And the outlook on the margin side?
So margins are, actually strictly speaking, core margins are running at between 3.2 and 3.3%. However, the interest reversals on account of recognition and the non-accruals are the ones which are largely impacting. So if resolutions, as we are expecting, work out, they will also have a corresponding beneficial impact on margins. So the core margins are already at 3.3. So some of these one-offs which have been, let's say, we've been observing them for the last 2 quarters to possibly a little bit 3 quarters as well, have been, we are having to report lower margins in terms of the disclosures. And the other part is the activity on CASA. While first quarter I will not attach too much of trend because it is seasonally usually weak as far as CASA is concerned. Our average CASAs are maintaining, or give or take, they are there, even though the headline CASA is a little lower from the sequentially previous quarter. And there is room to improve. Our retail share of funding is going up. The CASA that we have, let's say, relatively lost is not the retail CASA as much as the other retail CASA. So the prognosis continues to be, I would say, as it has been, that we should be looking at improvements coming on the liability side, impacting margins for the better. However, currently we are hurting on the asset yield side because of interest reversals and non-accruals resulting from NPA recognition.
Perfect. Thank you.
Thank you. The next question is from the line of Manish Shukla from Citigroup. Please go ahead.
Yeah, good evening and thank you for the opportunity. So when you guide for a 125 basis points credit cost, what is the coverage that you're assuming, either on the incremental NPA or on the stock of NPA by the end of the year?
So again, I think, our current PCR is there is very clearly an intention on our part to steadily take that up to 60%. But for this year, we will maintain PCR at about 40%.
Okay, fair point, thanks. Coming to the BB and below, the size of the BB and below at the end of last quarter was about 180 billion. Am I correct there?
230 billion.
230
billion, which has gone up to 290 billion.
So that essentially means that if you assume 45 billion of slippage, 110 billion addition during the quarter. Is that the right number? So you said 45 billion slipped to NPA during the quarter, and the stock is now at 295. That means 110 billion rupees of addition.
So I have not done that math, but I'm assuming you have done the math correctly. So the slippage has from the... Sorry,
BB and below.
Say your question again.
So the slippage from BB and below you said is 45 billion rupees as of last quarter. So that was 230 minus 45. And now the stock is 295. So that delta is 110.
Yeah, that's correct.
So 110 is the downgrade to BB and below in this quarter.
Yeah, so Give or take, yes.
Right. I mean...
like 100, not 110, yes.
Okay. And as we see, I mean, daily in the news reports, right, the pace of rating downgrades as far as rating agencies are concerned, that continues. So between December and now, only 5 accounts have led to BB and below going from 2.5 to 9.4. So just wanting to understand, just going back to your comfort on not much further addition to this pool from this point forward.
So like I mentioned to you, that if I look at, our portfolios, which typically, tend to be sensitive, and, which attract attention from a asset quality standpoint, I did mention that our total SMA 2 book is, for the corporate side, is 4 crores. And for the real estate side, is 255, which is part of the 4 and 4, of course. 4 and 4 is for the entire book. So we think that the exposure that we have now, from a portfolio perspective, from an individual counterparty perspective, in the foreseeable future, we don't see any slippages into the BB and below book.
Okay. And lastly, on capital, the resolution was $1 billion or 10% dilution. Does the 10% dilution still hold?
So no. So I think, like we had clarified the last time round, the 10% was not something that was self-imposed by the board or by the bank. That was the advice that we had got from proxy advisors, that if you go for an enabling resolution, then investors typically don't agree to more than a 10% dilution. But if you have a specific deal, price, size, all in place, then they will give approval for more than 10%. So the option to go beyond 10% is very much on the table.
Okay. And sorry, last question. Was today's board meeting attended by the RBI nominee director?
So Mr. Gandhi was in California, and he was in VC for the entire board meeting.
Okay. Thank you. Thank you. Those were my questions.
Thank you. Ladies and gentlemen, due to time constraints, we'll take the last question. That is from the line of MP Mahesh from Kotak Securities. Please go ahead.
Good afternoon. Just a couple of questions. One, if I look at the ALM table which you reported on March 31st, there shows roughly about 25,000 crores, which was up for maturity for a period of 90 days. Just trying to understand, you guys repaid the entire this much amount of money during this course of this quarter, because the loan book seems to be flat.
So I don't have the table you're referring to right now in front of me, but yes, the funding continues to be on an ongoing basis.
No, I'm just talking about the loans. The loan shows roughly about 25,000 crores, which were up to maturity over a period of 3 months.
Some of that could also be behavioral classification on account of overdraft and CC facilities, because a part of a loan book does not have a set maturity. So we look at the observed behavior of that book, and we ascribe that to the future. Okay. But usually those loans will also be, let's say, rolled over, or those companies will also continue to have working capital requirements. They will keep the money utilized.
Okay. And the second question, on the retail side, was there any direct assignments which, on the back of which the growth in retail has been much faster? Because you've seen a fair amount of securitization which has happened in the market.
No, I think the entire growth has been organic. It has not come on the back of buying out any portfolios.
Okay. And final question, do you have what's the definition of retail term deposits today?
So the branch banking deposits is what we classify as retail term deposits. 2 crores.
Is there a quantum under which you...
2 crores is the RBI threshold in any case.
Maximum?
Maximum, yeah. So it used to be 1 crore, but RBI has lifted the definition of retail to 2 crores.
Okay, perfect. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, that would be the last question for today. I now hand the conference over to Mr. Ravneet Gill for closing comments. Thank you, and over to you, sir.
I would once again like to thank you all for dialing into this call. As I mentioned that, this was really a quarter of consolidation. And I think the way we have been able to navigate through that gives us a lot of confidence in terms of our performance going forward. Thank you once again for your support. And, hopefully going forward we can surprise you on the upside. Thank you very much.